Most LP investors start in multifamily. And multifamily is a legitimate starting point. It's the most widely understood asset class in private real estate, with decades of institutional data, predictable demand drivers, and a deep operator ecosystem. But it's not the only asset class available to passive investors. Self-storage, industrial, mobile home parks, and other commercial asset types increasingly offer LP investment opportunities, and each has a fundamentally different risk and return profile. In this video I'm going to walk through three asset classes, multifamily, self-storage, and industrial, so you understand how each generates returns, what the risks are, and what questions to ask before investing passively in each. Start with why asset class matters. Each asset class has different tenants, different lease structures, different capital requirements, and different sensitivity to economic cycles. An industrial property with a 15-year triple net lease to a Fortune 500 tenant has almost nothing in common with a multifamily complex where 200 tenants pay month to month. Understanding the asset class tells you what drives the income, and how stable it is. What the operator needs to do to create value, and how complex that is. How the asset performs in a recession. What the exit market looks like. These factors affect your return profile, your hold timeline, and your risk tolerance for a given investment. Multifamily, what it is and how it works as an LP investment. Multifamily, apartments. Any residential building with 5 or more units. Income driver, rental housing demand. Multifamily demand is driven by population growth, household formation, and the rent versus own calculus. When home ownership becomes expensive, multifamily benefits. Value-add opportunity, most LP multifamily deals are value-add, renovating units to charge higher rents. The GP buys a property with below-market rents, renovates, releases at higher rates, and sells at a higher cap rate-based valuation. This is the most common LP deal structure. Recession sensitivity, moderate. In a recession, households consolidate, some move down from Class A to Class B. Class B and workforce housing tend to hold occupancy better than Class A luxury in soft markets. But high unemployment affects rent payment across all classes. Capital requirements, ongoing. Multifamily requires constant maintenance, roofs, HVAC, plumbing, unit turns. A well-underwritten deal reserves for capital expenditures. A poorly underwritten deal surprises LPs with capital calls when systems fail. What to look for as an LP, the operator's track record specifically in value-add multifamily in that submarket. Renovation timeline. Rent growth assumptions compared to actual market data. DSCR cushion. Cap rate assumptions at exit. Self-storage, how it works and what makes it different. Self-storage, facilities with rentable storage units of various sizes. Income driver, life events. Self-storage demand is correlated to moves, divorces, deaths, business changes, and downsizing, events that happen in both good and bad economies. Self-storage often outperforms in recessions because people downsize and store. Lease structure, month to month. Storage tenants lease by the month, which means the operator can adjust rates rapidly to market conditions, up or down. Revenue management in self-storage is operationally intensive but powerful. Value-add opportunity, acquiring an undermanaged facility and improving occupancy, rate management, and operations. Some deals involve ground-up development or facility expansion. Recession sensitivity, historically lower than multifamily. Self-storage has shown resilience in recessions. It earned a reputation as a recession-resistant asset class after performing well in 2008 to 2009. Capital requirements, lower. Self-storage has minimal tenant improvement costs. No appliances, no unit renovations, no HVAC per unit. Operating costs are lower than multifamily. Risks for LPs, oversupply. The self-storage market has been overbuilt in some markets over the last decade. A market with 3 new facilities opening within 2 miles of your GP's acquisition can materially affect occupancy and revenue. Ask the GP specifically about supply pipeline in the submarket. Industrial, what it is and how it returns for passive investors. Industrial, warehouses, distribution centers, manufacturing facilities, last-mile logistics. Income driver, e-commerce logistics and supply chain demand. The structural shift to online retail has driven persistent demand for warehouse and distribution space near population centers. Last-mile industrial, smaller warehouses within 1 to 2 hours of major cities, has been especially strong. Lease structure, longer, often triple net. Triple net, NNN, leases pass property taxes, insurance, and maintenance costs to the tenant. The result, lower yield but much more predictable income. The operator collects base rent with minimal surprise expenses. Value-add opportunity, acquiring older industrial and repositioning it for higher value uses, subdividing large warehouses into smaller multi-tenant spaces, or acquiring below-market leases and marking rents to market on renewal. Recession sensitivity, mixed. Logistics and e-commerce industrial holds well. Manufacturing industrial is more sensitive to economic cycles. Capital requirements, lower than multifamily, higher than storage. Industrial tenants often require tenant improvements, dock modifications, clear height upgrades, electrical capacity. These are deal-specific costs that need to be underwritten carefully. Risks for LPs, tenant concentration. A single-tenant industrial building where one company pays all the rent has concentration risk. If that tenant leaves at lease end, your occupancy drops to zero. Ask how many tenants occupy the property and what the lease expiration schedule looks like. Entry point, industrial LP opportunities are available but fewer than multifamily. The asset class requires specialized operator knowledge. Vet the operator's specific industrial track record, not just their general real estate track record. Comparing the three as a passive LP. For income stability, industrial with long-term NNN leases offers the most predictable income. Multifamily with good occupancy is reliable. Self-storage is month-to-month and can flex both directions. For value-add execution, multifamily has the deepest playbook and the most operators who know it. Self-storage value-add is simpler but requires specific operational expertise. Industrial value-add is deal-specific and requires specialized knowledge. For recession performance, self-storage has historically been most resilient. Industrial logistics has performed well recently. Multifamily workforce housing holds reasonably well. Class A multifamily and manufacturing industrial are more cycle-sensitive. For minimum investment and deal availability, multifamily dominates. More GPs, more deals, more accessible. Self-storage and industrial LP opportunities exist but require more searching for operators with the right track record. For LP due diligence complexity, all three require the same core diligence, GP track record, deal underwriting, loan structure, waterfall structure. The asset-specific questions differ, but the framework is the same. Questions to ask an LP on any commercial asset class investment. 1. What is your specific track record in this asset class and this market? A multifamily operator who is now pitching a self-storage deal requires separate evaluation of their storage-specific experience. 2. What drives demand for this asset type in this submarket? Generic, strong market fundamentals answers aren't sufficient. Ask specifically about submarket vacancy, new supply pipeline, and demand drivers. 3. What is the lease structure? How long are leases, who bears operating costs, and what happens at renewal? 4. What are the major capital risk items for this asset type? For multifamily, it's deferred maintenance and unit renovation. For storage, it's competitive supply. For industrial, it's tenant improvements and lease renewal. 5. What is your exit market? Who is the likely buyer of this asset at disposition? A well-defined buyer pool at exit means more competitive pricing. An illiquid asset type with few buyers means exit risk. Here's the summary. 3 LP accessible commercial asset classes. Multifamily, value add, ongoing capital requirements, moderate recession sensitivity, deep operator market, most LP deal access. Self-storage, month-to-month leases, lower capital requirements, historically recession resilient, supply risk in overbuild markets, smaller LP deal ecosystem. Industrial, longer NNN leases, predictable income, logistics demand driver, tenant concentration risk, specialized operator expertise required. All three can be excellent LP investments with the right operator and underwriting. None is inherently better. Match the asset class to your risk tolerance, hold timeline, and the specific operator's track record. The LP due diligence checklist has asset class specific question sections, linked in the description. Subscribe for the next one. We're going to talk about how to build a passive income portfolio, how to diversify across deals, operators, and asset classes over time. Thanks.